Does it feel like your dollar is purchasing less and less by the day? And is the steady erosion of your purchasing power putting your retirement at risk? How can investments in safe haven assets like gold and silver stop the bleeding? Gold is expected to benefit from several drivers in 2024. In this video series, we will cover the top 5 gold price drivers and reasons to invest in gold in 2024. To learn about all 5 reasons right now, plus a bonus, see the link to the full article in the video description. With prices still elevated, high interest rates, and the mounting national debt, the present and future purchasing power and cost of living of everyday Americans is more and more uncertain. If you think that you may be falling short of your retirement goals, see the link in the video description to the free inflation and retirement calculator. Gold price driver number 5, U.S. fiscal uncertainty, the U.S. national debt. The U.S. Treasury plans to borrow $816 billion in Q1 of 2024 alone, the most ever borrowed in the first quarter. In 2023, the U.S. government had crossed the line of $34 trillion in debt. In the past 2 years alone, we have seen the U.S. government run wartime deficits in a peacetime economy. At this present rate, the U.S. is adding $2 trillion to its debt every year in what could be described as good times. To quote Mark Goldwine, Senior Vice President at the Committee for Responsible Budget Management, if we keep adding this much to the debt, in good times, things could get really awful in bad times, and we can't grow our debt faster than our economy forever. To this point, the United States debt to GDP ratio is 123%. This would require a lot of economic growth to overcome. At $1.7 trillion, the fiscal year's 2023 annual budget deficit was the 3rd largest ever in history. This amount is staggering considering the lack of actual crisis. Furthermore, the interest expense alone on the debt is projected to be $1 trillion or more at the present interest rates, creating what is known as fiscal dominance. Remember that term. You will be hearing more of it as the year goes on. So how exactly does that affect gold prices? We are getting to that. The real question is, how will the government pay for all this debt and interest? A balanced budget? Given the spendy culture in DC, not likely. Will either political party raise taxes in order to bring this budget into balance? Not if they want to get re-elected. Who will pay the piper? This expense, as always, will be passed on to present and future generations through inflation, the invisible tax. Inflation is taxation without legislation. According to the data provided to us by the same spendy government, inflation has been going down from its 9% peak in 2022. Many Americans are still recovering from the losses experienced during this period, and the Federal Reserve's aggressive hiking policy to counteract this inflation that they initially thought was transitory has only increased the cost of debt and the interest lending burden on ordinary Americans, adding insult to injury. It is largely believed that the Federal Reserve has ended their aggressive interest rate hiking campaign and that interest rate cuts will begin sometime in the first half of 2024. Interest rate cuts usually weaken the strength of the dollar and send the price of monetary metals like gold and silver up. The value and price of gold is inversely correlated with the strength of the dollar. It is worth pointing out the obvious, that prices are still rising just at a slower pace. The Fed's 2% sweet spot inflation target, as measured by the fairly dubious government data, still equals, at best, a 2% erosion of your wealth and retirement savings year over year. Imagine your doctor telling you your health is declining at 2% per year, not improving. Good job. Suffice to say, 2% inflation is just enough loss of purchasing power and currency depreciation to go relatively unnoticed. Whether you earn a paycheck, dividends through stocks, interest through bonds, or any other income stream, once you get past the tax payments, capital gains, and other administrative costs, you are still experiencing, at best, a 2% loss in wealth due to inflation. Gold investing plugs that hole by providing portfolio diversification. Gold acts as a hedge against your losses in other income channels caused by the uncontrollable burden that is inflation. Gold also appreciates in price the longer you hold it. The reported measurements of inflation are one thing. The average lived experience by the regular everyday American is another. Please kindly leave a comment on your personal experience with the cost of living and its effects on your day-to-day behaviors. Remember, your retirement savings are also dwindling at the same time. Gold price driver number 4, quantitative easing, how gold prices are affected by interest rate cuts. The next driver of gold's price in 2024 is accommodative monetary policy and the associated dollar weakness. As stated in the previous video, the servicing costs of the U.S. national debt will be in the range of $1 trillion this year at the present Fed interest rate. Unfortunately, quantitative easing by central banks, or money printing, stated loosely, is the standard remedy to a highly indebted system. It is largely believed that the Federal Reserve has ended their aggressive interest rate hiking campaign and that interest rate cuts will begin sometime in the first half of 2024. This projection is subject to change, of course, barring unforeseen economic black swans or the early onset of a recession. Simply put, interest rate cuts usually weaken the strength of the dollar and send the price of monetary metals like gold and silver up. Simply stated, the value and price of gold is inversely correlated with the strength of the dollar. It is worth noting, if the Federal Reserve pivots their monetary policy too early, this could lead to a resurgence of inflation. If this renewed inflation cross-current meets a recessionary front, this could lead to stagflation, which pushes gold prices even higher, as seen in the turbulent stagflation period of the 1970s. Considering the large amounts of fiscal spending that is still pouring into 2024, the prospect of this resurgence of inflation could be more of a possibility. The Federal Reserve can push down the demand side of inflation, but they have very little influence over the supply side, driven by uncontrolled government spending. This prospect of fiscal dominance is also accelerated by the historic debt-to-GDP ratio of 123% presently. This ratio is predicted to grow even more if the U.S. continues down this path of uncontrolled spending. It is worth repeating Mark Goldwine, the Senior Vice President at the Committee for a Responsible Federal Budget. We can't grow our debt faster than our economy forever. Essentially, for the past 2 years, the Federal Reserve has been slamming on the economic brakes as the U.S. federal government has been pushing on the fiscal accelerator. As the U.S. central bank begins to lift its foot off the brakes of the American economy by cutting interest rates on the demand side of inflation, the fiscally driven supply side of inflation is ready to peel out of the parking lot with greater speed. The end result being a weaker and inflated dollar and a dramatic surge in the gold price, as seen during the volatile period of the 1970s that witnessed violent waves of inflation, each wave larger and more intense than the last. Gold price driver number 3, world central banks buying gold in record amounts. The U.S. Federal Reserve's approach to increase the money supply and monetize the ever-growing national debt will in turn weaken the dollars being held by foreign national banks around the world. Given this fact, countries with sizable dollar reserves are increasingly converting their reserves into tangible assets such as gold. Nations like India, Russia, China, and Brazil are leading this trend by buying gold at an unprecedented pace, disrupting the balance of power between the East and the West. In years 2022 and 2023, central banks around the world have purchased more gold than any time in recorded history, according to the World Gold Council. In 2022 alone, central banks collectively increased their purchases by 152% to more than 1,100 tons. This was an all-time historic high. The council also expects this strong buying demand to continue into 2024. This mass increase in gold holdings and exodus from the US dollar as a central bank asset is not just isolated to the emerging and expanding BRICS nations. Polish and Dutch central banks within the Western nations are increasing their gold purchases as well. In 2023, the Polish central bank stated that they want to double their gold reserves to up to 600 tons. By amassing gold, these institutions are tactically positioning themselves to counteract potential losses that they perceive with the dollar in the medium and long term. If the smart money is buying gold for what they perceive as growing weakness in the US dollar, it only makes sense that the ordinary citizen prepare as well. This trend isn't just about hedging against inflation or economic instability. It's a calculated move to diversify reserves and reduce reliance on the dollar. Central banks are essentially returning back to the historic money status of gold, both as a form of diversification, a hedge against potential crises, and its scarcity of supply. Stated simply, central banks can't print more gold. The trend is clear. Central banks are no longer selling gold, they're buying it. They're reducing the supply on the markets, effectively driving up the demand and the price of gold. As the collective acquisition of gold increases and the reserve holdings of US dollars decrease among these central banks, this will gradually create increased inflation of the US dollar, as the existing supply will be exported from foreign nations back to the United States. Other international currencies don't offer a compelling alternative, as they are based on unconvertible fiat paper. The lack of a strong alternative accelerates this process of de-dollarization, leading leading to increased demand of gold and thereby weakening the dollar's position as the global reserve currency. Gold is the only true global currency that is accepted due to its time-tested trust and store of value. No other form of money has this legacy and has withstood thousands of years of countless economic cycles. Fortunately, this move away from the dollar will be gradual, which buys time for the ordinary investor. Simply put, buy low, not FOMO. Gold price driver number 2, de-dollarization and rising political tensions. There's been much talk and no shortage of hype and theories about this particular subject, de-dollarization, with regards to its timing and velocity. Regardless of the differing opinions of many of the macroeconomic experts in terms of its forecasting and time horizon, the process has begun and it is accelerating. The BRICS nations, Brazil, Russia, India, China, and South Africa, as members, have already been trading commodities such as oil in their own currencies, not the dollar. The introduction of the membership of Saudi Arabia further threatens the US dollar's global reserve status and its dominance as the petrodollar. Furthermore, the original BRICS coalition alone share a global GDP that is now overtaking the previously dominated Western G7 nations. With the 2024 entry of the additional 6 nations, Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates, this will increasingly lead to a more bifurcated global economy and trading system, further isolating the dollar as a central bank reserve. As stated in the previous videos, building on the trend of de-dollarization, central banks around the globe are stepping up their gold holdings. This shift is largely a response to the diminishing purchasing power of their dollar reserves and what can be termed as a response to the weaponization of the US dollar. Irrespective of one's feelings and views of Russia's invasion of Ukraine in the spring of 2022, the resulting economic sanctions, seizure of foreign assets, freezing of Russia's currency reserves, and the punitive restrictions placed on Russia with the use of the SWIFT banking system created an atmosphere of uncertainty among Eastern Bloc nations. Moreover, this collective action by the G7 nations, more specifically the United States, has caused many foreign governments to further contemplate their participation in the dollar system and has created an impetus for these non-G7 nations to further distance themselves from the dollar reserve system. As with the case of the Russian invasion and resulting sanctions, the prospect of being considered and dealt with as a pariah state in the eyes of the Western nations has the potential to transform any country's dollar reserves from a highly liquid asset to essentially useless pieces of paper. Hence, we see the continued accumulation of gold and the reduction of dollars and dollar derivatives of these foreign central banks. Gold is a time-tested and universal form of money that every country trusts. It cannot be inflated or be confiscated if held domestically within the country's central bank. This provides security. Therefore, the mass purchases of gold are likely to continue throughout 2024, further pushing up the price of gold. Gold price driver number 1, the beginnings of a global financial crisis in 2024. Building on our previous videos, the number 1 driver of the gold price for 2024 can best be summarized as the cumulative effects of the previous drivers and leading to a possible global financial crisis. In the past 2 years, the cracks in the global economy have started to show in various sectors. The UK pension crisis, the no-bid Bank of Japan market, and the bank failures of Silicon Valley Bank, Signature Bank, and others are a handful of examples. Though having the appearance of isolated incidents, these various crises present as symptoms of a larger and deeper illness, which is an overly levered, indebted system. Central banks around the world can only paper over these problems for so long. Eventually, the government and institutional band-aids can no longer hold back the blood flow of what is really a systematic gaping wound. Arguably, this may be one of the reasons why central banks around the world are increasing their collective holdings of hard assets such as gold onto their balance sheets as opposed to US dollar reserves. One word: preparation. Gold is a Tier 1 asset that has no counterparty risk, is no one's liability, and has only increased in value during a time that can best be described as a 40-year plus debt cycle. Not coincidentally, this period aligns with the rise of widespread non-asset-backed fiat currencies that accelerated in growth after the abandonment of the gold standard in 1971 by the United States. During this cycle, the ability to increase the global debt without the need to increase the gold supply made way for an extremely leveraged system. The aforementioned recent banking and bond market crises serve as mere coughs and sniffles to the underlying disease of debt and leverage that is surfacing despite the mass amounts of fiscal medication that central banks are injecting into the sick patient, that is, the economy. At some point, the disease becomes too strong to mask. Gold has served as a universal safe haven asset and store of value for thousands of years. The US dollar, the cleanest shirt in the fiat laundry basket, will likely serve as an initial safe haven due to perception formed by many years of conditioning. Eventually, the strongest fiat lifeboat, the dollar, will reveal its numerous holes. One can surmise from viewing these recent economic trends that we are seeing the beginnings of an end of a failing 50-year faith-based fiat experiment. It is worth noting this period is the exception, not the rule of humans' history of commerce, although many living do not know any different. With the further revelation of these economic fault lines, we may be seeing a reversion back to the historical mean of the necessity for sound money backed by actual, tangible, hard assets, not faith and trust. 2024 gold price driver bonus. Buy low, take advantage of headwinds. Ironically, anyone who's interested in buying gold should quietly hope for a stronger dollar in the near term, and that the Federal Reserve's pivot from hiking to cutting to be delayed. Why? Buy low. This has the effect of keeping gold's price down, or given the recent activity, keeps this asset temporarily range-bound. It is worth noting that in the year 2023, practically every possible headwind to gold existed. High interest rates, a stronger dollar, savings yields finally returning, increase in bond investments, and a momentum-fueled equity market. Still, in spite of all these counter forces that typically push down the price of gold, the yellow metal made all-time highs in 2023 and has remained above its new support level. This should tell you something about this asset. It has remained extremely resilient in times where it should be going down in price. Another short-term driver that creates a great buying opportunity for gold is the initial onset of a recession, coinciding with a steep equity market correction or crash. At the end of 2022, the prospect of a recession in 2023 seemed imminent, but didn't surface, at least within the government data. Opinions may vary on this subject depending on one's lived experience of 2023, of course. Many macroeconomists have pointed to the lag effects of the Federal Reserve's tightening policy being delayed so significantly due to the immense amount of fiscal stimulus that has been injected into the U.S. economy within the last 3 years. This stimulus has essentially delayed the felt pain of the aggressive rate hikes. Again, many economists differ on this subject. If a recession is to finally take place in 2024, accompanied by a large equity market crash, gold is the first commodity to suffer, but the first to recover. Why is this? As seen in prior market crashes, panic selling ensues among traders. To cover margin losses within the market's steep downward correction, a general liquidation of anything of value follows. Hence, the mass selling of gold creates liquidity. This drives down the price of gold temporarily. This is the opportunity. Then, typically, the flight to a safe haven asset, such as the US dollar, takes place. Nearly simultaneously with this crash, the Federal Reserve begins cutting interest rates at a rapid pace and as a result, creating inflation, thereby negating real interest rates. As a result, this in turn gives rise to a flight to another safe haven and defensive asset, which is gold. At this stage, gold has already decoupled from the S&P and quickly recovers, the price shooting up as the equity market further corrects downwards. Also, the dollar's strength continues to weaken as a result of the accelerated monetary easing from the U.S. Central Bank. This pattern has been observed to various degrees in past market crashes and recessions, or recently the Great Financial Crisis of 2008 and the tech market crash of the late 90s and early 2000s. A new gold bull market emerges as a result. If past is prologue, this is one more price driver dynamic to pay attention to. Whether you are in the soft landing or hard landing camp in terms of economic forecasting in 2024, the best present option for gold investing is to dollar cost average into gold while still at its present low and range bound. Therefore, the classic investing advice still stands: buy low. With this in mind, 2 quotes from the famous Canadian hockey player Wayne Gretzky come to mind. "I skate to where the puck is going to be, not to where it has been." Also, you miss 100% of the shots you don't take. If you are interested in learning more about gold and its role as a portfolio diversifier, hedge against inflation, protection from counterparty risk, and building generational wealth, see the links in the video description. If you are a serious investor with at least $100K in investment savings looking to take advantage of the most competitive gold prices, see the link in the video description to attend a free gold educational web conference held by Augusta Precious Metals. Thank you for watching. Please like and subscribe if you enjoyed this content.